happen. You're asking, what are the plausible outcomes? How likely is each one of these outcomes? So you separate the process from the outcome. Now, sometimes you make the right decision and you still lose money. Sometimes you make a bad decision and you get lucky. Handicapping cares about the decision process, not the actual short-term result. If one outcome has a modest probability, but a massive upgrade, and the downside is survivable, that's worth paying attention to. You don't need certainty, you need favorable odds. Step number 3, find the edge. This is where most people get uncomfortable. Your edge is simply where your view of the odds differ from the markets. If you see the same probabilities that everyone else sees, you're not going to outperform by definition. Edge comes from doing work that others won't, thinking in time frames others can't, or understanding constraints that others ignore. Sometimes the market's wrong because it's emotional. Sometimes it's wrong because it's constrained. Sometimes it's wrong because it can't move yet. Your job is to predict when that changes. It's to recognize that it eventually will. And step number 4 is watch the positioning, not the noise. Now, this is the most important step. It's the most misunderstood step. Positioning tells you more about future price than any chart ever will. Like, who already owns it? Who can't own it yet? Who will have to own it if certain outcomes materialize? You see, capital doesn't move smoothly. It moves in waves. It moves under pressure, and it often moves all at once. The biggest opportunities usually show up when the odds are improving, but the positioning hasn't caught up yet. And it's that gap between improving odds and delaying positioning is where asymmetric outcomes come from. And this is the anchor idea to keep in mind. You don't need to be right. You need the odds on your side and the positioning to change in your favor over time. Now, once you start thinking this way, price stops feeling like a signal. It starts feeling like a lagging indicator. Now, let's apply this to Bitcoin. If we look at sort of the big stage here, we can see that government debt is basically unserviceable. We can see that the debasement is policy. We can see that AI is accelerating everything. And so Bitcoin sort of sits at the intersection of all this. This is the Q wave. It's what I call the quantum wave, the quantum leap. It's a once every few decades transition. So institutions aren't going all in, but they're allocating 1%, 2%, 5%. Bitcoin's moved from unthinkable to now at least taking a small allocation. And this is where people ask, should I lump sum in or should I dollar cost average in? And that question assumes certainty. So let's flip that. What probabilities do you assign to each outcome? If you think there's, let's say, a 50% chance that price goes lower, why stay 100% in cash? Maybe you allocate 50% now and then keep 50% dry, right? That's not guessing, that's handicapping. The same question at a higher level is Bitcoin zero, or does it have a 5, a 10, a 20% chance of success? If the answer